All right, welcome back. We're doing another basic stock analysis, this time on Gap. Ticker symbol GPS, market cap about $9.36 billion and selling for right under $25 a share. So I think everybody knows what the Gap does. If you want to read more, you can pause it and read this description. I'm going to move on to the financial statements though. All right, let's go. So I got the last 15 years of quarterly reports exported into this Excel sheet, and we're going to use that to do all of our valuations. So first up is the revenue. So we always prefer growing revenue. This is obviously not growing, but it's not shrinking either, so I'm okay with that. It's relatively flat. I mean, I'm going to give them a pass on this COVID year, or COVID quarter, 2 quarters really, but it's just something to keep in mind. All right, next, what I think is one of the most important metrics, we're going to do look at the gross margin. So the gross margin is a great way to measure a company's competitive advantage because it shows what kind of premium it's charging its customers for its product. Low gross margin would tell me that it's got a lot of competition. High gross margin, very good. And even better than high is high and increasing. And this is increasing, so I really like to see that. We're at a highest gross margin that they've been at in the last 15 years. So that is great, especially with all this inflation we're seeing now, that they're able to pass those increased costs on to the consumer. So, I mean, not great if you're a consumer, though, right? All right, so that's good. Let's move to our pre-tax income. So, pre-tax income, y'all know this already. I prefer it to after tax just because I think you get cleaner information from using it. So that's what we're going to use for our one of our valuations. So what do we do for what we're trying to do here is we're trying to project what we think it's going to be because that's what we're going to use in our valuation. So looking at this, and you might have some kind of inside knowledge on what you think Gap's going to do, and that's where your edge comes in as far as investing goes. But I'm just kind of going through the motions and showing you how to do these valuations. So I'm going to take a more conservative approach. You may think they're going to start making 500 million per quarter again, and you could put that. And if you have reason to believe that, then I think you're fully justified to put that there. I am going to be conservative though, and I'm just going to take the last 4 quarters. Be boring. So the last 4 quarters, $744 million. So that's the sum. So the last 4 quarters, the last year, 744 million. So I'm going to put this 744 mil as our pre-tax for yearly pre-tax income. All right. So next we're going to look at earnings per share. So, I'm sorry. Before we go to earnings per share, we got to get a growth value here, and this is another thing. You got to pick how much you think it's going to grow in the future. I mean, if you go to, it really hasn't grown in the past. Usually, I use past growth as to try to figure out future growth, but I don't know how you would do this one. One way to do it, I suppose, would be to say, okay, they made what is this, 300? They made $360 million in the most recent quarter. I think in 2 years they're going to get, or how about I think in 3 years that they're going to get to 500. So that might be what somebody thinks. I'm not saying that that's what you should do, but if you think this way, this is kind of how you would do it. So if you think that they're going to get to 500 in, let's say, 5 years, you would do this, 500 divided by 364. So you think they're going to go up 1.37 times in 5 years. Raise that to the 1 over 5, and that's your annualized growth rate, 6.5%. I mean, I just kind of wing that. I'm going to go lower than that just because, like I said, you always want to be more conservative here. The best way to lose money is to get over ambitious with your valuations and your metrics, and then you think you got this great deal and you get all excited and you put a bunch of money in it, and then it never really gets any money. You wind up losing money, so you don't want that. So I'm going to go a little conservative. I'm going to say 4%. But like I said, if you got an edge and you think that it's going to grow, then put what you think. That's how you make money in the market, is by using using your own edge that you have over everybody else. All right, so last for the income statement, we're going to do diluted earnings per share. So with the exception of the COVID quarters, this is looking pretty good. So especially recently, it looks like we've recovered and growing. Looks like they're hovering right at this 50 cent per quarter. So I'm gonna, be lazy and just say 50 cents per quarter times 4. So $2 a share, $2.00 per share. All right, let's move to the balance sheet. All right, so first up on the balance sheet is total tangible assets. So this is everything a company owns minus all the intangibles like goodwill. All right, so you can see here it looks like they made a big, either investment or purchase or something recently. So I'd be interested to see if that helped our equity or hurt our equity whenever they did that. What we're going to use here is we're going to get a pre-tax return on assets. So I really like using return on assets because I think it's very intuitive. I've described this in the past, but if you're starting a new business and it's going to cost you, 100 grand in equipment, you want to know how fast you're going to be able to pay that off, and that would be a return on assets number. So we're going to kind of do that same thing here. So all right, pre-tax, we're going to take our pre-tax and say it was 744 million, but I'm going to do 0.744 because we're going to keep it in billions. So yeah, 0.744 billion dollars divided by, and we are at 13.6 billion. So 5%, 5.5%. That's pretty low, but it could just be, I'm not very familiar with the retail sector, so it could just be a function of having a lot of, assets. But that's low. That's the equivalent of that $100,000 equipment example I gave earlier. That mean that you'd put up 100 grand and you'd only get $5,500 a year. So, but that's not a deal breaker. Just so y'all know. All right, next we're gonna do tangible equity per share. So this is gonna be total tangible assets minus all of our liabilities divided by the number of shares. All right, so you can see we were growing good. This is where they made that big purchase. So it looks like, yeah, they raised the assets, but they also went in a lot of debt to do that, or else our net worth wouldn't have dropped. So they raised our assets, but dropped our net worth. But recently growing. So I really like to see growing equity in a company. If a company, you got to think about it like personal finances, right? I don't care how much money you're making. If your net worth isn't going up, what's going on? That's something's wrong. And same thing's true with companies, with the exception of dividends, right? Because if they're paying dividends, that technically won't show up here, but still. So I like that it's growing. This is a little confusing that their assets went up, but we dropped equity at that time. So, or they could have, I guess, diluted the shares to do that too. I'd have to look into that, but that's just something else to look into. All right, we are going to get a return on equity from this. So this is a per share basis. So we're going to use our earnings per share. So we're going to do $2 divided by this 8 here, because that's what it is right now, divided by 8. And that's 25% return on equity. That's pretty good. So solid return on equity, but you always want to also look at your price per book value in conjunction with your return on equity. So basically to do that, you take the current share price, so 24.89, divided by this $8, whatever your tangible equity is, so 8. And so we're selling about 3.1 times tangible equity. That's okay. I'd like to see that a little bit lower, especially with that low return on assets, but I think that with a return on equity of 25%, I think it's okay. There's nothing. It's not like I said, haven't seen a deal breaker yet. All right, cash flow statement. We're only going to look at one thing from here, the free cash flow. That's the most important thing in the cash flow statement, and I think it's, for a lot of people, it's the most important thing in all of investing. Free cash flow is just like you can think of it as it's a monitor on the company's checking account. It's looking at the cash coming in from operations and then how much money is reinvested into the operations through capital expenditures. So anyway, same thing with pre-tax. We got to try to estimate what we think it's going to be because that's going to be our valuation. I'm gonna do the same thing, or I'm gonna do something similar to the pre-tax. I'm just gonna take the last 2 quarters. So the last 2 quarters we made 500, and they had 523 $1,000,000 of free cash flow, 523, and I'm gonna turn that into a yearly amount. So last 2 quarters is half a year, so I'm gonna just multiply by 2. So 1.05 billion dollars of free cash flow per year. All right. And finally, we're going to move to valuation, what everybody probably just fast forwarded to. All right, so the first, we're going to do 3 valuations: a pre-tax rule of thumb method that I love. It's been done me really good. Then we're going to use the Bingram formula from the security analysis, I think. And then we're going to do a discounted cash flow for the last to get a net present value, All right, first one is this pre-tax income. So 744 million. So I'm going to keep that in billion, 0.744 billion times 10 divided by your number of shares. So, all right, so we are going to get $19.78 per share. I'm going to round up. I'm just going to say $20 a share. We're going to do the next one here, earnings per share. So earnings per share times 8.5 plus 2 times your growth. So my growth was 4. $33 a share. Pretty good. All right, and then lastly, we're going to do our discounted cash flow. This is not on the calculator. This is on this Excel sheet. So what you're going to be looking for is this graph here is going to make like a plateau, and that's going to be our net present value for market cap. All right, so free cash flow, 1.05 billion. Perpetual growth rate, that's usually about half of whatever growth rate you used in the other formula. Some people do other stuff, but 2%. And then a discount rate, I'm going to discount at 15%. Oh, that's not going to work. 15%. All right, so what we get here is a market cap of, it's right over 9. Let's see, I got it here. You can't see it, but $9.29 billion. Well, that's funny. That's almost exactly what it is. So 9.29 divided by 0.376 for the amount of shares outstanding, and we get 24.7. So I'm going to do 20, round up, 25. All right, so we got 3 different valuation numbers. One of them came in under, one of them came in over, and one of them came right on the share price. So I just want to talk through each one for a second. So this first one, in the pre-tax one, I think I took a very conservative approach there. They could very well start making the double of that 744 million. They could make double that in a quarter. Yeah, I mean in a year, not in a quarter, in a year. Like I said, if you think like these are just the formulas, right? The real key to investing is putting the right numbers in. So I could totally see how higher pre-tax income could raise that intrinsic value up. The next one is higher. I think it benefited a little bit from my kind of manufacturing of a growth rate. So it is what it is. And the last one I kind of agree with. I think that's pretty spot on as far as the share price, discounted cash flow. We did it for 100 years. That's our net present value. And a lot of people, that might be the main valuation that they use or the only one they use. But anyway, if you're interested in the company, I encourage you to do your own research. I'm not a financial advisor. I'm just trying to teach these methods, and I hope you learned something and enjoyed the video. And if you did, please like and subscribe for more, and I will see you next time. Thank you.